Hi, my name is Marlana Lancaster. I'm a financial planner here with Financial Management. Alongside me is David Elmore. Happy Friday, David.
Oh, it is Friday. Well, it's tax season, so all the days are alike. It all blends together.
It's true. It is a Friday towards the end of March. It's the end of tax season, and everyone's getting tired these days. So there's an event that's happened in the last month that have rattled the markets a little bit. Would you care to address or talk about the U.S. bombing Iran and how that has impacted the markets and people's portfolios?
Yeah, it is. It's surprising to me how it's not as bad as it feels for some reason. So the markets are down year to date about 5% as of Friday, March 26th, and we talked about whether we'll talk about this specific incident with the U.S. U.S. and Israel bombing Iran and causing oil to go up, causing the stock market to go down, because it is a current event, and this will end soon, as the president has said, and so probably a month from now, nobody will even remember what happened. But that's the now. It's down about 5%, and these things are very normal in the investment world. We expect the markets to go down 5 to 10, maybe even 20% in any given year, at least once and maybe twice. We just never know when or why. Well, in 2026, the when is now, and the why is the U.S. Bombing Iran. So it'll pass. There's certain real reasons why the markets have corrected or gone down. It's not a correction, have gone down, but they will go away, and everything will be back to normal soon.
I appreciate that. You said a word correction. Can you identify what an actual stock market correction is?
So when any particular stock or index goes down 10% or more, and so year to date we're down 5%. Now it's not necessarily peak to trough because January was a good month, but yes, it's gone down. Well, as I said, it feels worse than it is, and it always feels worse than it is. I mean, when we talk about this and we tell clients even ahead of time, the market and your account will go down 5 to 10% in any given year, and but it'll come back, and they accept that. But it hurts when it's happening. It feels very painful. And so this is, even though markets are only down 5%, it feels longer than usual, but it really hasn't been. I think it was mid-February or something like that.
Do you have any strategies that you tell clients when they call and they're upset because of whatever news source they're listening to or whatever social media site? Do you give anybody any tips and suggestions? I have two.
I do. One is to turn the TV off, and the TV at the end of the day will say the S&P went down, and that Nasdaq went down, the Dow went down, whatever any of that means. And those happen to be indexes or measures of a group of stocks. Well, what is a stock? A stock is ownership in a company, very simply. And the example I like to use, and many people have heard this, I used to work for Coca-Cola Company. It's one of my favorite companies. And I own Coke stock. Most of you own Coke stocks. And as owning that stock, we own the company. And every day, hundreds of thousands of employees around the world go to work for Coca-Cola, manufacturing, distributing, marketing, all to make a profit for Coca-Cola. And as Coca-Cola makes a profit, their stock inevitably goes up or it pays a dividend. And I'm the benefactor of that. And so at the end of the day, all this esoteric language about the S&P or the Dow or the Nasdaq, it's really about my ownership in Coca-Cola. Coca-Cola is well over 100 years old. It's not going out of business, and my stake and my ownership in that is not going away. It may go down because of all the noise out there, but at the end of the day, my investment is solid.
That's a great explanation. And that certainly helps as well myself alleviate clients' fears. There's a lot of local industries around here. There's Merck, it used to be GE, Dominion Power, pick more, Daikin. You mentioned Coca-Cola, but Hershey. There's a lot of local companies, and at the end of the day, that is ultimately what the stock market is. It is ownership in companies, and that, much like yourself, probably as an advisor, gives me peace and rest at night, knowing that no matter what happens in the world, it's our job to manage through whatever the world throws at us, and we want to own actual companies that make goods and services.
We the current event with Iran is driven by our current president, and whichever side of the political argument you're on, it doesn't really matter. Policy, government policy does affect things, and we pay attention to that, and we manage towards that. But Coca-Cola is still distributing Coke. Budweiser is still distributing beer, and those are our faith. Our faith is in God, but our investment is in companies, and primarily U.S. based companies, that we believe in the product, we believe in the governance of that company, and regardless of the political winds that are in Washington D.C. or in your state capital.
So regardless of who's in office, Lowe's is still going to sell tools and supplies for the house.
That's exactly right.
Okay.
Yeah.
Well, I love that. Here's another question sometimes I'll get. Should I get out of the market? So David, should I get out of the stock market now? It's going down.
Yeah. The short answer is no. And the reason is several facets. One is nobody knows when the bottom is, and so therefore nobody can time selling. So you have to time the market twice. You have to time when you go out of the market, and you have to time when you go back in the market, and nobody can do that. And there are plenty of algorithms, computers out there that have tried to do this, and some say they can, but the consistency and the reliability of those programs is flawed. And so we do not do that. We generally stay invested through downturns, but it's wonderful for us. And I know that sounds terrible, but with this 5% turn down in the stock market, it's great because part of our philosophy is active management. And with active management, we'll look inside of the portfolio, we'll look for opportunities to sell positions that we don't think are that great of a position to go forward, and we'll buy things that we think have a lot of growth upside, and that really propels our portfolios out of these downturns. Yeah, so it's always a great opportunity to put some additional cash that may be on the sidelines into an investment portfolio when things are down.
Right. We also tell people, if you're dollar cost averaging, if you're putting money in on a monthly basis, don't stop. You're not chasing good money after bad. That's a phrase that oftentimes we'll hear. Just keep buying, and it will recover. And most of these portfolios are built for the long term. So I asked a second ago, what do you tell people? And you said, turn off the news. Yeah, 100%. 30 minutes, no more than 30 minutes should you be collecting the news, or you're just going to be depressed. The purpose is always to, smartness here, pull on the amygdala in the brain, to pull on the emotions in the front of the brain. So, yeah, you got to turn off the news. And the other, how often should you look at your portfolio?
Well, it depends on somebody's. I know I've heard you say to people, just look at it once a year. We send our firm, we clear securities through LPL Financial, and they send statements now quarterly. And I think that's a great period to be looking at your portfolio. All the while, as I've said, we actively manage our clients' portfolio. We're looking at it every single day. We're looking at the economy, the macroeconomics around the world every single day, making changes to clients' portfolios. So, that's on us. That's not on the client or the investor. That's on us.
Right. And I do tell people once a year. If it's good, I'll look at it twice a year, but once a year. You mentioned LPL. We do have LPL Account View. It's a beautiful little, we can log it on the computer. It's also a nice app with facial recognition, so you can check your portfolio. If you're prone to getting emotional, don't look. If you're cool with it, then you can look all you want. But I do tell people once or twice a year. It's a good point.
I don't want to get geeked out too much here with what we do, but it's fun. The active management part of what we do, it really is fun. With this current Iran crisis, oil has shot up to about $100 a barrel. It actually got up to 120, where it was about $70 a barrel going into this conflict. And oil companies like Exxon have really benefited from this. And so we held Exxon in our client portfolios, and so we've benefited. And we've actually sold some of that, took profits off the table, particularly when it was at $120 a barrel. And that type of active management is just, it's just great. It's just wonderful.
Right. So. I agree. Yeah, I think Exxon stock was $165 a share today.
Yeah, it's pretty amazing.
Yeah, so it's pretty amazing. I agree. Yeah. Okay, I'm taking you back a couple years. We've been in this new building for 2 years. Prior to that, we were right next door in a round building surrounded with glass. And I've sat in many meetings with you, and there's a story you would oftentimes tell people. Would you share that with the audience?
Well, when we start a relationship with people, and particularly when people don't have a lot of experience in investing, and we talk about what's going to happen, we talk about, long term we're going to make money, but there's going to be periods, as I've already articulated, in any given year, there's going to be at least 5% correction, probably 10, and maybe even a 20% correction, and that's just normal. But even though it's normal, it's not going to feel good, and there's going to be times when you really don't like me because I'm managing your portfolio and you've lost money, and you're going to want to drive down the street and you're going to take a brick and throw it through that window because you're so angry. And that's okay. Well, it's not okay. Don't do it. But if you do, just remember to attach a check to invest more money, because that's the exact time that you're going to want to add money to the portfolio.
It's a great story, and it's a great visual that I always appreciate. So to recap a little bit, when we go through market corrections that are going to happen, they always happen. Sometimes we can tell when they're happening. We can never tell when we're coming out of it, but we can't time it, because you have to guess twice when to get out and when to get back in. It's easy to get out. It's impossible to get back in, because you got to get back in when the world feels like it's falling apart and when you want to throw a brick through a window. So I appreciate that. So we can't time the markets. You have to time it twice, when to get out and when to get back in. When you get in, out's easy when the markets are going down, but you got to get back in at the worst point. There are some great statistics that show, and the markets move really rapidly these days, way too fast. And so if you miss those first couple days in that recovery, your overall return drops in half. And I can't quote proper statistics now, but it's literally, if you miss those first 10 days, your overall return drops exactly in half. If you miss more than that, suddenly you might have a total negative return. And so that's part of our job, is to coach our clients through that, what to do, what not to do, plan properly. So I think that's it. Thank you for joining us today on this episode of the FMI Podcast, as we talk about market volatility, geopolitical events, and ideally what not to do. But always feel free to reach out with any questions you have. We're happy to help you and guide you through it anytime.
Great. Thanks, everybody.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA, SIPC.